Hello, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for December 6th of 2021. Please see our disclaimer for important information. Well, as we kick off the chart pack this week, I wanted to spend a little bit of time on labor. Obviously, we've been talking a lot about the issues in the labor market. The job numbers that we have been seeing have been very good. We know that there's a real choke point with regard to service industries and lower skilled and semi-skilled labor is in relatively short supply. And right now we have more job openings than we have unemployed people, which seems counterintuitive. But part of the reason why we have a labor shortage is we've had a lot of retirements. A real spike in retirements is that people that are, a little bit older in age are just leaving the workforce. And, COVID has been an input into that, a big input, as a matter of fact. As we see here on this first couple of charts, it deals with labor participation. And so we've had people exit the workforce. Now, some of these folks can obviously come back in to the workforce, and they do when the job market is typically good. However, you can see here clearly that the levels that we're enjoying right now, are not nearly as high as they were pre-pandemic. And on the left-hand side, it breaks it out between men and women. You can see, in the blue, light blue there with the left-hand chart, you can see participation rates for men were hovering around 69, and then they dropped into around 67, 67 and a half. And that number has been kind of, with a few fits and starts, has been relatively steady. Now, the participation rate for women on the right-hand margin, the line in black, you can see it trends in much the same way. However, participation rate amongst women is much lower. It's in that 56 category as opposed to maybe call it 67 for men. And that was one area with regard to the pandemic that we absolutely saw some issues. More moms had to stay at home and deal with child care issues because child care facilities and operations were not operating. But you can see the trend lines here. We need to get more people in the workforce, more labor supply to soak up these open jobs. Now, on the right-hand side of this chart, you see, a different take, kind of a breakdown, if you will. And this is the decomposition of the decline in the labor force. And you can see unemployment is a big issue, but that's going away. So we're kind of narrowing the delta between the participation rates pre and post pandemic due to unemployment, because there are more jobs out there and the labor market is progressing, but we do see aging as a factor, and that has to do with some of these retirements. And then there are other factors that are kind of like, in this nebulous COVID category, people not wanting to come back to work, or, really in between, or just deciding that they want to, be a part of this gig economy and not have a full-time job necessarily, but maybe do part-time work. Here's a quick look at the industries that have been most impacted by wages. And so this is actually categorized from data from Morgan Stanley, or analysis from Morgan Stanley, rather. This is where we see not just the biggest exposure in terms of wage increases, but also the areas that have the greatest risk going forward. You can see, wage increases have been fairly pronounced in the hospitality sector, real estate, commercial services, leisure products, so on and so forth. You can see on this chart all those in blue, which are really outsized moves. And this is where the risk lies going forward. And it's been real tough for hospitality to work at high capacity because of lack of workers. And same goes for most of these that are referenced here in the blue. Interestingly enough, something we haven't looked at in a while is Challenger. Challenger is a data firm, and this is job cut announcements. And as you might expect, firms are not laying off people. In fact, they're struggling, as we've just noted, on hiring people. And so, not too surprisingly, we see a huge drop off in job cut announcements, and expect that number to be low for a fairly long time as this labor market tries to kind of filter through some of these choke points. Now we'll go ahead and pivot away from labor and talk about inflation for a minute, and to kind of bring you up to speed. There's some interesting developments kind of on the margin with regard to inflation, although the narrative still remains the same, that it is still relatively high. But we're beginning to kind of take a look down the road and see where inflation is going to hit. Again, I think the Fed has just recently come out and said, you know what, we kind of missed that a little bit. We do think that there's a fair amount of this inflation that's not going to be transitory. And we've been talking about that for quite a while. The feeling, my feeling is that, that we were always going to be looking at something north of the inflation levels that we've been enjoying over the last several years. And this is really an interesting compilation forecasts from Bloomberg, historical data provided by the Bureau of Economic Analysis, but you can see the trend in inflation here, especially in 2021, and that spike above the 5% level. This is the Fed's preferred measurement of inflation. It's personal consumption expenditures. Now, the important thing here that I want to focus on is what happens on the right side of this in the blue bars. These are Economist forecasts, and people begin to look out over the next 5 and particularly the next couple of years, and even some people looking at over 10 years, you can see that trend line is down. So inflation is widely expected to come down, but you can see that level, if you look over from 2016 over to 2020, what we're going to have in the coming couple of years is going to be something north of what we've enjoyed, in the past. But that's not necessarily bad. But the directionally, I think we can expect that to move down in a pretty meaningful way over the next couple of years, and then settle out at something. Right now, the consensus seems to think it's going to be maybe 2.25%. But that we'll have to wait and see. But clearly the trend lines for inflation are down. Well, as we continue the conversation about inflation, I wanted to show you this on the left-hand side from the San Francisco Fed that did a really neat analysis and kind of broke out the COVID-sensitive areas of inflation versus the non-sensitive areas. And as you can think about, the things that we saw really spike earlier in the year, things such as car rents and hotel rates and things like that, that were really sensitive to the emergence of the economy and getting back into the economy. You can see really in the black line here that the COVID sensitive areas are really what's driving inflation right now. And there's a large basket, and I thought this analysis was exceptionally interesting because when you break out and look at essentially the COVID insensitive areas, you've had a much more benign response to the pandemic than you have otherwise. And you see that those numbers on both the PCE, personal consumption expenditures data, as well as the CPI, which is in the lower left, essentially corroborate the same story. Now, if you look over to the right, you've got information from BLS, from the Bureau of Labor Statistics, analysis by Haber, analytics there. And so they break out services inflation from goods inflation. You can see where goods inflation has really spiked. And in fact, in many respects, the core goods inflation really has overshot, and because of the demand factors that were driven by the pandemic. And you see services inflation has actually been a little bit below trend line, but it's been much more steady than goods inflation. And I do think this argument that's being made in the headline here is apropos, that if you have not some outright declines, because we're not going to see that, but a less acceleration or maybe a deceleration of some sort, albeit leaving positive growth in inflation on goods, that could actually support disinflation overall in 2022. And I think this is one argument that we have that we can use to say, all right, we know inflation's probably peaked or very close to peaking right now, and that 2022 is going to be less. 2023, as we saw in the forecast in the last chart, that we're expecting a meaningful decline over the next couple of years, and I think this might be one reason we get it. All right, now we're going to look at some data from BKA research group out of Montreal. It shows inflation expectations for the next several years. So this is from TIPS, for the Treasury Inflation Protected Securities, and this is the implied expectations curve. And what does that mean? It just, it's what the TIPS yield is subtracted from the 10-year Treasury. And so this is what the implied inflation rate is as you look out over the next 10 years. You can see where we were in November, which was essentially the last month relative to the beginning of the year, which was much, much more benign. So obviously, as inflation did spike, towards April, May timeframe, has kind of remained steady. You can see overall inflation expectations have remained high, but the important takeaway here is you get into on this chart, year 2, which in this case would be 2022, and you look out over the next several years, it gets down into that 2.8, 2.7, below 3% category from where we are now, and then it slides down even further to kind of a terminus of somewhere slightly below 2. So again, the 10-year look forward on inflation is still really benign. So what we're not doing is extrapolating current inflation out to the long-term future and saying we're going to have a lot of inflation out into the future, because I think there is a fairly strong consensus that, one, the Fed's going to control inflation, two, that a lot of the causal factors behind this, as we saw in the very last slide, happen to be pandemic sensitive areas where inflation is not going to be persistent looking out into the next year or so. I thought this was really interesting, and this came from Trahan Macro, and it shows you kind of a breakdown of the age of the people that work in the banking or financial industry. And interestingly enough, a cohort that fits me is in that 23%, 55 or over, that basically only a quarter of the people that are in banking and finance are in that 55 years or older category. And most of the younger folks, the 18 to 54, really have no recollection of what high inflation really looks like, because we've been in kind of the secular decline or secular period of low inflation for several decades now. And it's really interesting that a lot of people out there just don't have any institutional memory of what that felt like. All right, I wanted to give you a bit of good news here on the supply chain front. And so I've got two charts here that I came across in the weekly research. One, we've got on the left-hand side in that blue, in the blue area there underneath that line, is the number of container ships waiting outside the port of LA and Long Beach. You can see that number's really dropped off. So we did see a spike of really over 80 ships that were at anchor waiting to port full of container ships, and then unfortunately a lot of container ships being sent home or being sent back across the ocean half empty and so on and so forth. But the number of container ships waiting to port has gone down significantly, and that's really a positive development as they've gone to that 24/7 and have imposed kind of holding fees, if you will, as an incentive to get the whole bottleneck situation worked out. On the right-hand side, you've got the container freight index. So as we work through these bottlenecks at the port, we're also seeing some relief on the rates for shipping. All right, now we'll transition into the stock market. I actually have a lot on the equity market this week. There's a lot of interesting stuff going on here. So, with the market activity, and last week we were down for the week in the S&P 500. So, we've had we have seen some of the volatility increase that we've been long expecting. Left-hand side, we've got a decline in the number of stocks that are trading above their 200-day moving average. Now, that number, was quite a bit higher just literally a week ago, and so we've seen a 20 percentage point move, and now we have less than half of the stocks in the New York Stock Exchange that are below their 200-day moving average. I think that's healthy. I think it creates a little bit more value. Technically, it's not necessarily the best thing to see, but it does create a better environment for future stock appreciation. Right-hand side, we've got the differential between the new highs and new lows, and obviously, with a market that it was somewhat depressed last week, we've seen a spike in the new lows, and you can see that very clearly over the last handful of trading days. So one thing that we've been talking about for quite some time is the lack of volatility, the lack of 1% moves either way over the last year. And so, if you look at the median, which is that black line from 1999 to 2020, you can see as you get through the year, this is a cumulative line. So, you go through the year, that number, should go up, right? Because you're just counting more instances in that. But as you look at 2021, we were pacing because we had a little bit more volatility earlier in the year, and we were pacing pretty well until we got to about May. And then I think we started to see an increase in, maybe some complacency in some of these things, which was really interesting to me because we had that spike in inflation and the equity markets just plowed through. Now, a lot of this had to do with the fact that technology was very strong. We had really strong earnings. And there are obviously some other factors at play here, the feeling that we're continuing to sport, strong earnings and economic growth. But, we have seen increased complacency for the most part until just recently here. And we saw a little bit about a volatility in October. So you see that blue line that's kind of falling below that that median line. So it's just to highlight here the fact that we haven't had the kind of volatility this year overall, point to point, that we usually do. So quick look at PE ratios since 1920, and looking at different inflation buckets. So again, if we're interested in the correlation between inflation and stock price performance, this is a good chart to start with because the pink line represents where we are now. The current forward PE is around about 21 times earnings. And so, and then you break it down into these kind of cohorts for inflation. So, really what would support the current multiple would be a low inflation rate, like 1 to 2%, which is not unlike the inflation rate that we've seen, for a couple of years. Now, if you get to 2 to 3%, then you tend to see multiples that are a little bit more in line, like 17 or so. And then obviously higher inflation tends to correlate very strongly with lower multiples. So again, there's an argument there that I think is very strong that we're going to have declining inflation over the next couple of years. Next year, inflation rate's going to be lower than it is this year, more than likely. But what does that translate into multiples? And so I think what this chart tells me is that I think the challenge for the equity market's going to be not earnings necessarily, although we do expect earnings to slow, but it's more so going to be the issue of we're not going to get price appreciation coming from multiple expansion. That argument is really tough next year. So it's going to put more pressure on earnings to continue to drive stocks higher. All right, we're continuing this conversation about stocks now. And getting back to kind of the tie-in between inflation and financial conditions. And when you talk about financial conditions, you're talking about a lot of different things. You're talking about, the Fed raising interest rates to tighten credit. And when the Fed raises rates, you tend to see lenders raise rates. You tend to see your prime lending rate go up, mortgage rates go up, a lot of consumer loan rates go up, so on and so forth. So when you get to tighter financial conditions, it tends to correlate really well with market multiples, meaning that there's really an inverse relationship. And this is, in light of the chart that we just looked at, the tie-ins between market multiples and inflation levels, that this should not come as a surprise that there's kind of this inverse correlation, if you will. And that's demonstrated very well in these areas. Now, the pink shaded areas represent recessionary periods, and you can just see here, that we've had the PE in the market, price to earnings ratio, move higher on balance over the last decade. At the same time that over the last decade, we've had this secular decline or easing rather in financial conditions. And so, this particular chart kind of hypothesizes that the next leg up in financial conditions is going to be to tighten. And so, one would seem to infer from this, if conditions do tighten, that we're going to have a little bit of challenge in equity market multiples. So as we look at the S&P 500 forward PE, again, this is showing you data that you've kind of already seen a little bit, but it just isolates the PE, and it just kind of shows you a little bit, the kind of the forecasts as we look ahead. So, right now we're about 21 times as of really the end of the month. But we've been in kind of a holding pattern, which is really interesting. For quite some time, right? And I say quite some time, that really dates back to kind of the middle of the summer of last year. And we've kind of been in this holding pattern. Multiples have declined a little bit. And, so I guess, in counter somewhat to the argument that I made, or to the comments I made in the last couple of charts, where I do think market multiples may be a little challenged. I think the issue though is, are we going to see like a huge drop in multiples? And I don't see that. I think this would tend to tell you, amidst some of this, amidst a high inflation rate, that that we're just going to be stuck here. We're not going to get multiple appreciation, but we're not necessarily going to have multiples fall off the floor either. So we look at this chart, and this kind of actually looks at something a little different. So this is kind of the E in the price to earnings ratio, the operating earnings annual growth forecast. And so it breaks this down by years, and it shows you the forecast as it changes over time. You could see, if you look at the green line, 2020. Well, as we, in 2018, that was looking about plus 10%, and we got 10%, and then it dropped off a little bit, and then the pandemic hit, and then we troughed out, but that moved higher throughout the year as we hit our recovery. And so even though 2020, that green line there, I mean, we were definitely negative. Well, at the same time, we were forecasting 2021, which is in the red line, and you could see that those numbers have really continued to go up ever since we announced, where we got the fourth quarter earnings reports in 2020 of last year. The estimates for 2021 have gone through the roof, and that's where you see that red line at the top there. Now, interestingly enough, as we have gone throughout this year, while the 2021 estimates have come up, the 2022 estimates and that little kind of like that blue squiggly line there have actually gone down. So we're almost, the thinking by one person's judgment is that perhaps we're borrowing growth from next year because our earnings estimates are beginning to trail off. They started off about, plus 15, 16%, and now they're down around 7 to 8%, which is absolutely not catastrophic. In fact, 7% I would take in a normal year. In fact, if you look at the left-hand side of that chart, most years it's in that roughly, call it 5 to 15% level. So where we're looking for 2022 is not bad, even though those numbers have come down a little bit. All right, now another thing that we've been talking about for years now has just been this money flow issue, and despite the equity market, we've seen many years where we've seen a lot more inflows into fixed income, even at a time where interest rates are extremely low, and the prospects for return in fixed income have really not been that great. And so consequently, we haven't seen a big surge in equity inflows or equity market new money inflows. But this year is definitely an exception. And a lot of things might be at play here. I think the emerging economy, I think a lot of people chasing returns. You've got more individual stock owners that are in the market, the younger age cohorts that are saving and buying like 1-2 shares here and there as part of their Robinhood account. But the equity market inflows have been outstanding this year, and this liquidity infusion, as basically more dollars are chasing the same number of stocks, is really had an influential impact on the equity markets this year. So interestingly enough, we talk about the S&P 500. One thing that I want to note here is that the Russell 2000 has not enjoyed the same success. We haven't seen the same response at all in the small caps, and as a result, multiples for small caps are much more attractive than they are for the overall S&P 500. I think that's highlighted here. And we did see a breakout in small caps in November, up until actually October, November, up until we started getting some additional inflation data, and we had this most recent sell-off. And so you've got small cap stocks that are by and large relatively close to the kind of the bottom area of their trading trend for 2021. So sentiment indicators. This is the American Association of Individual Investors, investor sentiment. They're bearish readings, and not too surprisingly, after the last week, we've seen a pretty stout spike in that. So a high degree of bearishness. I mean, this is sometimes, a pretty decent contrarian indicator when you see bearishness peak. And I wouldn't say this necessarily peaked yet, but if it does peak, then that would certainly be a signal to go buy. So this is something I wanted to also talk about. We've talked a lot about market movements, price to earnings ratios, so on and so forth. And I think this has a lot to do with the story, even though we've seen a pickup in breadth of the market. So what are we talking about with breadth? It just means the degree to which all companies in the S&P 500 index are participating in the move of the index itself. As you can see in the upper part of the chart, the kind of the almost strangely linear growth rate and expansion in the index here. But as you go down to the breadth composite, you can see that growth in the index is being generated from a fewer number of stocks, if you will, meaning the breadth is going down, and so a fewer number of stocks in the index are having an outsized influence on the direction of the index. While the index is going up, not necessarily all companies are helping to participate in that. In fact, there's a lot of publicly traded companies. Even though we've just now seen this 5% move in the overall market, we've got a lot of stocks in the index that have had 5 to 10% moves easily this year. We'll talk a little bit about fixed income. So obviously, when you have equity market disruption, you have fear enter the market, and I would say that a lot of the activity last week and certainly the Friday after Thanksgiving was the fear trade. It was driven by fear, not fundamentals. As a result, we have seen a little bit of flattening in the yield curve where rates in the 2, 3 to 5 year category have moved a little higher, whereas long-term rates have moved a little bit lower. And sometimes you see that when you get a spike of inflation. Now, you would expect rates to go down if you have a fear trade and people are buying treasuries, so it's driving the price up and yields down. But here is more of a feeling of what's happening on inflation, that the Fed is maybe going to, step on the gas a little more at a time where we're dealing with Omicron and the impacts of potential slowdowns and supply chain breakdowns and things like that might lead to an economic slowdown down the road. And so that's what's, you can interpret from this chart here. But, I think it's way too early to determine whether even Omicron is going to have an impact, a meaningful impact on the economy. One thing I would definitely urge everyone listening to this to consider is that, we had the initial shutdown, very painful. There is very little political will for shutdowns. In fact, we have, and there's a chart coming next week probably that shows you that the shutdown index, globally is really gone down. Even during the surge in Delta, we had a very strong reluctance to impose restrictions on commerce. And so I really do feel like the environment with Omicron is not going to be particularly adverse. All right, we'll talk a little bit about energy here because I think this is important. And so we've seen a big correction in energy prices. Now, OPEC has ramped up their supply, and then we have this fear that we're going to not have as much demand, which is going to leave surplus stocks. There's a lot of, I think, cross currents going on in energy right now, but I want to caution you against getting all wrapped up in that, because look at the lower left, crude oil stocks. I mean, they're below their 5-year range, and actually, not just by a sliver. We're absolutely at a point now where we are undersupplied in the market relative to demand. We need more production. Now, on the upper left-hand side, you can actually see that we have seen a little bit of a supply response in U.S. crude. But at the same time, you've got a lot of bickering amongst OPEC cartel members that want higher prices. So, what we increase in terms of production here in the U.S. might be offset by OPEC. But in the upper right-hand side, you can clearly see this reversal in trend dating back to September in crude prices. All right, and something else that I've been looking at as well has been construction spending, and it comes as no surprise to see that residential spending has gone through the roof. We're supply constrained in an environment where it's a struggle, particularly for new home purchasers or first-time buyers to find available product that's actually affordable. And so, the supply response has actually been pretty pronounced. You can see that in that dark, kind of that purple line. Now, the red line represents non-residential construction. And so this, in some respects, is not too surprising either, because you see that dip in 2020 is related almost entirely to COVID and the shutdown of the economy, and this new trend about the future of office. And I think, while there are going to be projects that are going to be built, that are going to need to be built, I think right now there's a real reluctance on the part of developers to jump headlong into a lot of commercial development. On the right-hand side, you've got lumber prices. That we were talking ad nauseum about the spike in the April-May timeframe, and we saw kind of almost a cascade down in prices and a settling out and a bottoming in August. But interestingly enough, we're starting to talk about that lumber inflation, and lumber is just a proxy for a basket of industrial commodities that I think we are dealing with some inflation pressures, some of which based on supply chain choke points, but a lot of it has to do with just outright demand. Fear and Greed Index. This is from CNN Business, and we're trending in a very different way right now than we were literally a month ago. I was getting concerned that this chart was indicating extreme greed, and the fact that the high degree of complacency. Markets were kind of moving linear in an upward fashion, kind of unabated. Well, that's all kind of been turned on its ear over the last week, and actually I think that's really productive for a lot of different reasons. We talked earlier about the decline in the number of stocks trading above their moving averages, and here we're talking about the factors amongst investors kind of shifting over to a fear. And I think when you see these types of things kind of peak or trough, depending on the indicator, that's a real good time to want to move a lot of money into the market. Well, that will do it for the slide deck this week. Hope you've enjoyed it. On behalf of the entire team at BKA, hope you have a wonderful week, and we look forward to talking to you again soon. Take care. Bye-bye.